Welcome to week 4, Coleman's SBA 2015 Certified SBA 7A Loan Underwriting Training. That's a big mouthful. Stealth panelist Lance Sexton. Lance, thanks for joining us. But you're not stealth, you're on camera.
Not hiding. I'm happy to be here today, Bob, and it's great to be here with the new group.
Lance is the former Deputy Director of the Loan Servicing Center out of Little Rock, out of SBA's Loan Servicing Center, professor at the Sam Walton School of Business and University of Arkansas. Lance, you're our trainer for closing and liquidation, and I appreciate you hopping on because my other stealth panelist, Nathaniel Booker, is not here today.
Well, I'm happy to be here and happy to add whatever I can to the office hours. I know how important
to play stuff the professor for you. Well, let's get into it. You know how to ask the questions. I got a couple questions this week. First of all, I want to start out. Last week, someone sent me a very nice comment saying they liked the book, but they didn't like my faction. I thought that may have been a typo. I thought maybe they said fraction. I had no idea what that was. It dawned on me yesterday that they were referring to my World of Warcraft Horde mage, undead mage. So I believe that's what the reference was. I appreciate the shout out on that. Please feel free to elaborate. So for those of you who don't know World of Warcraft, there are two people in the world. There is Horde and Alliance, good and evil. Of course, if you're Horde, you don't fall into that. But anyway, that's my comments. Let's go into the poll, Joseph. What is the most important information obtained from an accounts receivable aging? This is subjective. There may not necessarily be a right answer. This is for discussion purposes. I give you 3 choices. AR turn. What's the amount of our 90 days or sales concentration? Lance, I'll let you weigh in. What do you think?
Well, I think there's more than one good answer.
Good.
But the best answer is accounts over 90 days because, you know, we want to take a close look at those. Those may not be considered in valuing the accounts receivable, but we also are very concerned about the accounts receivable turn, Bob, based on the industry that they're in. I think it would be critical to take a look at their turn and compare it to an industry standard to make sure they're turning the inventory. Bob, you don't know this, but I actually was a Radio Shack franchise store.
Oh, I know that. I know you were. I'm glad you're out of that business. When did you get out of it?
I'm thankful to be out right now. I got out about 15 years ago.
Yeah, that was a wise decision.
But accounts receivable turn is also a very critical number. It tells you a lot about the small business's buying habits, and it tells you a lot about their marketing.
Let me tell you my answer. By the way, 56% say the turn, 44% say 90 days, 0% say sales concentration. Lance, I'm going with 0%. The reason why is because I can calculate the turn just with the number. I can calculate those other 2 things, but I want to know what my sales concentration is.
Well, now, Bob, being from Northwest Arkansas, it is a very common thing to find a sales concentration in accounts receivable because there are a number of small businesses that 80% of their sales are to Walmart.
Right.
A sales concentration is not a bad thing if it's to someone like Walmart, but if it's a sales concentration to Fred's Tire Shop, you know, then you may want to find out a little more about Fred's Tire Shop.
You and I have a different opinion about that. I believe if you have an 80% concentration to Walmart, you're an employee, not a small business person. So I only raised that to take a look at it. Everything else is important. I want to know sales concentration. I want to know if you're an employee, if you're an affiliate, or if you're a true small business person.
Well, and the other challenge, Bob, is if you do have a concentration to somebody like Walmart, I mean, many of my friends are senior executives there. They can pull the rug out from under you in a very short period of time. And when I was director of the Small Business Development Center, I advised my clients to avoid a concentration to Walmart.
That's why we raise that. Poll question number 2, Lance. The SBA SOP 5010-5H gives a detailed step-by-step guide how to complete the pro forma financial statement. Lance, since I have you on, your former SBA, where did we get 5 after the 5010F? I know the H's are A, B, C, D, E, and F, the changes, but what's a 5010-5?
Bob, I wish I could explain the 5. It's like many things at SBA. It's like my experience today, Bob. I was trying to get an answer from SBA, and I called the place that should have provided the answer. They referred it to Okram. Okram referred it to the National Guarantee Processing Center. Boy, sometimes it's confusing. So I'm not sure where the 5 comes from, but I know the letters indicate the version, and I've seen it go all the way from D to H.
I can tell you. Do you know where 7A comes from? 7A comes from the section 7A in the original legislation to establish SBA. Section 7 was we'll have a loan program. That's how I know 7A is from that. Anyway,
I'm curious what their answer is here, Bob.
What is the answer, Lance?
There's not a detailed step-by-step on.
We have 100%. You are speaking to the choir. 100% of you agree with that. One of my themes of this course, Lance, is underwriting is not A plus B plus C minus D plus F, and then yes or no, we can do it. It's creative. It's not creative writing, but it's creative in terms of how you come up with these numbers. You are not simply a advanced robotic machine spitting out numbers. We have a creative in terms of how we interpret the numbers. And pro forma.
One thing I'd like.
Go ahead, Lance, please.
One thing I'd like to throw in on the pro forma, Bob. As we all know, people can put whatever they want in the pro forma. What makes a pro forma a usable document is that summary of assumptions that's attached to it that explains where the numbers have been derived. As an example, you talked about inventory turn. It's really easy to calculate an annual sales level if you know a base inventory amount, the number of turns they have, the normal margin, and you can do an annual sales projection pretty well, and then you can break it down according to seasonality. I like that description on the summary of assumptions that tells me where the number came from, not that the bank or the small business just reached out and said, I think they can do $1 million.
Great. And the third poll question we have, there's 4 questions. Which of the following ratios does SBA demand in the credit memorandum for loans over 350 per the Bible, per the SBA SOP? Debt to worth, current debt coverage ratio, debt service coverage ratio, all of the above. And of course, it's all of the above. Those are the only 3 that SBA demands that you put in the credit memo. It suggests other ones such as AR turn, inventory turn, but you need those 3 as a minimum. Correct, Lance?
Yes, and probably all 3 are required, but the most critical of the 3 is the debt coverage.
Well, and I heart that. I emphasize that probably way too much. People are tired of hearing about it, but that is the only mandated number in the SOP. We need a 1.15 ratio, and that's the only mandated ratio. Lance, where they come up with 1.15?
Well, historically, Bob, 1.2 is what's considered a decent debt coverage ratio. SBA, I guess, decided to be generous and go 1.15. Quite frankly, this is one of those areas, and we've talked about this, Bob, in a number of sessions that we've done together. Even though it's 1.15, use prudent lending standards. If your bank likes a 1.25 debt coverage ratio, use that as your underwriting standard. But SBA, it's like everything, Bob. SBA interest rates, they establish that they provide a maximum. But you don't have to charge the maximum.
Right.
And on debt coverage ratio, they provide a minimum. But you don't have to accept that minimum debt coverage ratio.
I appreciate the questions. Thank you very much. I had a phone call this week. Thank you for that. And let's go into the questions, Joseph. What do we got for number 1? I'm sorry?
One more poll.
Oh, one more poll. I've been corrected. Go ahead. Give me the other poll. Nope. Oh. If a loan has a debt service coverage of 1.15 and is fully collateralized, the lender must approve the loan. True or false, Lance?
Now, Bob, it depends on who you ask this question.
Well,
if you ask me, the answer is false. If you ask the borrower, the answer is going to be yes.
This is not a trick question. You are allowed. We've met the minimum requirement. you do not have to approve the loan. That's the takeaway from that.
Yeah.
And
In fact, you're not required to approve anything
right.
that don't meet your prudent lending standards.
Right. Do not put into your credit memorandum, we're fully collateralized with 1.15, therefore we're approving the loan. All right, let's go to the questions. And 100% of you got that right. Thank you very much. Question number one. Yes, Lance, go ahead.
I hate to interrupt, but if you'll notice, Grace is very attentive to you today.
That is, for those of you who don't know, that is Mr. Sexton's dog. I thought it was Gracie. Is it Grace or Gracie?
It's well, either way, Grace or Gracie. But she stood up and paid attention when you started talking. All
right. Well, you tell Gracie no barking today. I think she barked at the last office hours for your class. Lance, the question is, I've referred to debt to worth. Some people in the readings, some people say they only want to have the debt of debt. In other words, they want all liabilities. What is it, Lance?
It's going to be all debt.
What about lease? What about lease debt that is not on the balance sheet?
You know, that's Bob. Why do you do that? I love seeing you
squirm. I love seeing you squirm.
Lease debt. It depends on the type that it is. I mean, if it's leased equipment, you need to include it. If it's a lease payment for the building that you're operating in, no.
Yeah, I think it's a material thing. If you have a $2,000 capitalized asset copier, I wouldn't worry about it with an $89 monthly payment. But it should be in your pro forma. This is where you put in your pro forma. You can capitalize those assets and include it in the debt. So I think.
Well, for instance, if you have a $500,000 piece of equipment that you've leased, that needs to be in there.
Yeah, and if the CPA doesn't put it on the financial statement, you need to account for that. In next week, we'll be getting into global cash flow. Will be sort of a prelude to that, but you need to account. Your goal is to account for all cash flow, and definitely lease. If there's leases that are material, it should be in the debt to worth ratio. Lance, we got the question. I'm confused. When do I calculate cash flow from the financial statement, and when do I use the tax return? Lance, the SOP says we need to calculate from historical statements, it's for the last 3 years, from a pro forma statement, and from projections. So
yeah, it does not indicate the tax return, and rightfully so, Bob, because the tax law is so bizarre for small businesses, and a tax return, while it is a reflection of the performance of the business, it's not the most accurate reflection.
But I can calculate it off a tax return, correct, Lance?
You could, yeah.
The purpose of this question is you as the underwriter get to choose what you want to do. And if you believe the financials are a more accurate representation of what the company's doing, you can do it on that. What SBA demands is, and the SOP is very clear, you need to have that 1.5 either on a historical cash flow going back 1, 2, or 3 years. And you can average it. You can take 1 year, simply indicating your credit memorandum how you do it. Franklin Brothers, it's a trap. They have cash flow, as we're going to see, for last year. They don't have it over 2 years annualized. Or we could do it on projections. The SOP allows you to go both ways. But you need to be clear on what method you're using. And I would also explain why you think a cash flow on a projected pro forma basis is better than on a historical. Correct, Lance?
Yes, that's absolutely. And that kind of leads into the next
question. There you go. And this one, I made this one up. I gave it to Lance. And Lance, can I do a cash flow off an interim financial statement?
Yeah, well, not an interim statement, but I'd take the interim statement and do an annual projection and use that.
Yeah. My response is I probably would not. My experience has been when I get interim statements, I see huge profits. Then when I get the year in, for some reason it's zeroed out by the CPA. I would be very leery of basing a cash flow projection on an interim statement, especially if it's not historical. The SBA is agnostic. They will allow you to do it, but I think you need to determine, would you do that for a conventional loan? If you wouldn't do it on a conventional loan, I certainly wouldn't do it on SBA.
Well, the deal with an interim statement is you could take that information and use it as a basis for developing a annual projection.
Perfect, thank you.
And you could use that annual projection in calculating cash flow, but you know, typically you're going to use the historical statements. One example, Bob, I told you I had a Radio Shack store. I incorporated in November. If you looked at my cash flow at the end of December, it was astronomical. But if you looked at it in June or July, it was more normal. I could give you an interim statement January or December 31, and it would look like I was a rock star, and you should open the bank vault up to me. But if you got my statement from June 30, you'd say, oh, not too bad.
Let's go ahead and give a preview of Week 5, Joseph. I think we talked about assets. Week 5 is calculating global cash flow. I spent a lot of time on what's appropriate add backs, how we can do this. And the takeaway that I have that I want you to know is, again, we don't have a way to calculate the pro forma. The SOP does not give you a specific way to calculate cash flow. You have a number of different ways to do it, but remember, you're writing this credit memorandum for who? You're writing it for the regulator, you're writing it for loan reviewers, you're writing it for, God forbid, Herndon on a Inspector General review 12 months down the line because something happened. So you need to craft it. You need to be prudent in terms of explaining why you are calculating cash flow that way, but clearly understand if something blows up, you may have an issue. Lance, what are your thoughts?
I wanted to add to that. I have worked 24 PDKs since January 1.
PDKs are purchase demand kits, for those of you who don't know.
Yeah, I'm sorry. Purchase demand kit. By the way, Bob, I've gotten paid 100% of the time, which is pretty amazing.
Good for you.
But I wanted to throw in the calculation, the credit memorandum, the calculation of your cash flow the correct way is so critically important, not just in the underwriting process, but heaven forbid if the loan does default and a purchase demand kit has to be prepared to get your bank paid on the guarantee, a good credit memorandum is going to make that job easier.
Great. With that, we're 18 minutes past. I try not to take too long. Joseph, do we have any questions? Hey, Lance, thank you for stepping in. I appreciate it. Gives us a little bit more flavor and insight what SBA is doing. Everyone enjoyed the Week 5 reading material. We get more into Franklin Brothers. And if you have specific questions, if there's things that you want to know, call me and I'll make it up as I go in terms of the case study. I think it's a fun way to learn that. Also, remember the option. You have the choice of taking the final exam, 50-question multiple choice. Lance, I'm giving them an option, though. They can choose to write a credit memorandum in lieu of that. What do you think of that idea?
Oh, I think that's a great idea. It's a good practice, and I think it'll bring as much value as taking a final exam. I like that.